Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us. Let's take a look at what's going on at a macro level. Most US Treasury yields dipped while the yield curve steepened ahead of tomorrow's non-farm payrolls report out of the States. Longer dated yields hit session highs after data showed the number of Americans filing jobless claims rose moderately last week, while layoffs declined in September, pointing to still tight labour market conditions. Although layoffs were 58% higher compared with the same period last year, and then just over 1.5 job openings for every unemployed person in August, and unfilled positions increased by the most in 2 years. The yield on the benchmark 10-year was down to 4.71%, and the 2-year falling 3 basis points to 5.02%. And San Francisco Fed President Mary Daly has said that the Fed may not need to raise rates anymore, saying if we continue to see a cooling labour market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. And with the rise in long-term rates in recent weeks, she said the need for us to take further action is diminished because financial markets are already moving into that direction and they've done the work. The US dollar retreated and tracked the pullback in Treasury yields, the Aussie rising to 63.7 US cents. All right, well, let's get more on the macro front and some investment strategy. Dave Sekera is the Chief US Market Strategist for Morningstar. He joins us now. Dave, very good to catch up with you. Thanks for joining us again at ausbiz. So we have seen a significant pullback in equity markets. On acceptance, I guess, given where we've seen those bond yields go, there is an acceptance in the market that that rates are likely to stay higher for longer. Has that reaction, though, been overdone, do you think, in your view?
Well, we think so because we don't believe in the higher for longer story right now. As you mentioned here in the short term, we do have the jobs report tomorrow, and we'll see where that number comes out. If it's either at or higher than consensus, we could see the market sell off some more. I think the market would price in higher for longer at that point. We'd see long-term yields, increase further. But if we come out lower than consensus, I do expect we'll see a market rally. Again, that'd then be a lower probability of additional rate hikes, lower probability of that higher for longer, and we'd start to see long-term interest rates, start to come back down. But for our outlook for, monetary policy here in the US, we think the Fed is done hiking rates. And the reason for that is that we forecast the rate of economic growth is going to start slowing here in the fourth quarter. And we think it's going to slow for 3 consecutive quarters. So it won't bottom out until the second quarter of 2024. Having said that, our expectation is for no recession. We also forecast inflation, or at least core inflation, will continue to keep moderating. Our U.S. economics team is looking for inflation to get back down to 2% in 2024. So in our view, the combination of slowing growth with moderating inflation, that gives the Fed the room that it's going to need to take its foot off the brake, and we should start seeing them ease monetary policy. In fact, according to our economics team, that could be as early as next March. So we're looking for a Fed funds rate of about 4% by mid-2024. Getting all the way down to 3.5% by the end of next year. And we're also very bullish on the U.S. 10-year Treasury. We think that it's gone up, way too much at this point. We think it'll start dropping. We look at getting down to about 3.25% by the end of next year.
All right, so that's interesting that your view then, just as far as obviously a slowing economy, but no recession, but more importantly, I guess, a pricing in those, we're looking to some aggressive rate cuts, certainly from the middle of next year. So, Dave, that said then, what's your equity market outlook? We are coming, of course, into the next quarter of earnings. What are your expectations there?
Yeah. Well, U.S. stocks, they peaked on July 31st. We briefly touched our fair value composite at that point in time. And in fact, in our August outlook, we recommended to investors to look through their portfolios, look for stocks that became overvalued, overextended, and it was a good time to lock in some profits. Since then, we've backed off about 7%. So right now, the U.S. market's trading at about an 8% discount to a composite of our fair values. And that puts it in pretty attractive territory compared to where the market's traded, over the past 10 years. So I do think now is a good time to look through your portfolio and make some adjustments, take advantage of some of these dislocations that we're seeing. Some of these dislocations really just occurring over the past week and a half.
Okay, so if we take a look at then perhaps what sort of, how you take advantage of those, the pullback that you've seen right now, how do you do that?
Yeah. A couple of different ways depending on what type of investor you are. I would note when we look at the different categories, yeah, we've actually moved growth stocks back to market weight from underweight. Been a lot of movement in that growth category this year. We actually started the year in a overweight recommendation, moved to a market weight in the summer, underweight in August, but now they're trading at an 8% discount, so pretty much in line with the market. So good time to get back to that market weight. By sectors, technology is a similar story. I think it's time to move back to a market weight there from an underweight. A couple of stocks there I'd highlight that we do still think are undervalued would be Qualcomm, NXP. A couple of artificial intelligence ideas that we like would be Snowflake and Cognizant Technologies. Communications still significantly undervalued, but it's no longer the most undervalued sector in our view. That actually now goes to real estate. It's trading at over a 20% discount to our fair value. So a lot of problems with like commercial real estate. Interest rates have taken their toll. But we're still seeing a lot of opportunities in different real estate sectors that have been pushed down, but pushed down more than they should have been. So among some of the high quality shopping malls, we still think Simon Property Group is still undervalued. Among some of the REITs, like the healthcare REITs, we like Ventas. Among the cell towers, we like AMT. But in that past week and a half, I think really the biggest story here in the US right now is the utility sector. It's trading very deep into undervalued territory. In fact, our equity team, they just recently published an article saying that it's now pretty much at the lowest valuations compared to, their price targets over the past decade. And so the Morningstar Utility Index down about 17.5% year to date. It's down 11% just in the past week and a half. And when I compare that to a long-term bond index, that's only down 10.7. So right now, the average dividend yield of utilities is only slightly below the 10-year Treasury. Of course, the benefit of investing in utilities, so we do expect they'll steadily increase, their earnings and their dividends about 6% over time. So a couple of different stocks that we like here. First on the we highlighted was Entergy. It's a four-star rated stock, trades at a 24% discount, has a 4.5% dividend yield. Our team noted they think that is the most attractive combination of yield, growth, and value. Second one would be NiSource, four-star rated stock, 27% discount, 4.2% dividend yield. And that one, in their view, has the longest runway for growth in the sector.
Dave, tech, interested to get your view then, specifically. Obviously, we have spoken about the Magnificent Seven quite often, and no surprise because of the stellar gains that have been made this year. So you point out that they were undervalued at the beginning of the year. How do you look? We can bring up a chart, in fact, just to check out their performance. But what's your assessment right now?
Yeah, we think that, they've kind of run their course for this, part of the market rally. So when we look at those, as you noted, 6 of 7 were undervalued coming into the year. They were rated 4 or 5 stars, but they've gone up so much now that only Alphabet is still rated 4 stars. So the other 5 stocks are 3 stars. That puts them in kind of that fair value territory. The one I would highlight would be Apple. We think that one's moved up too much. That's now overvalued. That's rated 2 stars. So I would really look for, other technology names. Names like Salesforce was one of the stronger names that we think, has some really good growth dynamics going forward. It's a 4-star rated stock, trades at a 20% discount to fair value. So I'd look to broaden out away from the Magnificent Seven. If you want to play artificial intelligence, again, NVIDIA certainly the leader there, but we also like AMD. It's a 4-star rated stock, trades at a 25% discount to fair value. And we think that they're positioned to be the number 2 player for AI chips, in the future.
Dave, you did mention energy there. What are you seeing, particularly with the oil price? It has come off quite considerably, yes, in the last couple of sessions, of course. There is concern about global growth, but then, of course, that's balanced with those cuts that OPEC Plus have made into the end of the year. So more broadly, what's your outlook?
Yeah, so the energy sector, after this recent move up, is the only sector we cover right now that we actually think is starting to trade into overvalued territory. Not too far into that overvalued territory that I think you really need to go, much into an underweight, but I would certainly look through, take some profit there, off the table. We have seen oil roll over and start coming back down, so a good time to lock in some profit. Couple of opportunities still left there. We do like the services businesses. We do like the pipelines business. And for people that are looking for an investment, they still think there's more room to run in oil. I'd highlight Devon Energy as our pick there.
Overall, Dave, You mentioned what certainly happened over the course of September. Do you factor in seasonality here? Traditionally, of course, we see a sell-off in September and then the market moves higher in October. Is that your expectation?
Yeah. Yeah, we don't really look to try and trade the market, based on seasonality. We really try and keep focused, on valuation. Now, of course, we do have earnings coming up. We're going to start next Friday here in the United States with the big mega banks. We have, JP Morgan, Citi, Wells, and PNC. So we'll see how that, kicks off the season here. Generally, I think third quarter earnings in and of themselves are going to be pretty good. In fact, they probably should be stronger than expected. The economy here in the US was very strong in the third quarter. I don't think guidance overall was very difficult to beat. Now, fourth quarter guidance, now that I think is going to vary greatly and going to be very idiosyncratic based on management teams. So while the US economy has been just defiant in the face of tight monetary policy, we expect the rate of growth to pretty much get cut in half in the fourth quarter. So we're looking for 3.9% GDP third quarter, going down to 2% in the fourth quarter. So we could see some companies still giving relatively strong guidance, but I do think that there are going to be a lot of management teams who are also looking and expecting the economy to weaken and probably start lowering guidance in preparation for that.
Dave, always terrific to get a view of your strategy there at Morningstar. Thanks so much for joining us.
Thank you.
Okay, just before we round it out, let's take a look at the next central bank to consider rates. The Central Bank of India expected to keep rates on hold later today, but any further liquidity withdrawal measures alone may push market yields higher, causing another increase in effective rates. Treasury officials and analysts have said. All 38 economists in a Bloomberg survey expecting the Reserve Bank of India's 6-member Monetary Policy Committee to keep the repurchase rate unchanged at 6.5% for the fourth straight time. There's a check of the market, so what we're expecting when we get to the open in just a couple of minutes' time, a modest gain. Stay with us.